Hey guys, welcome to Let's Talk Forex with Alison and Chris. So last week, Chris spoke about prop trading alone as I couldn't record. You'll hear about why in this episode. But in this episode, we talk about limit orders, what they are and how to use them. And as always, if you have any questions about how to trade using limit orders or any other Forex related questions, please send them through to us at podcast@fxscouts.com.
Hey, Alison.
Hey, Chris. How are you doing?
Yeah, I'm good. Happy to have you back. I was lonely last week.
Oh, I'm sorry. It's very good to be back.
It's great to have you back. What happened to you? Where'd you go? Do you want to tell our listeners what happened?
Yeah. It was we actually there was huge winds and rain, and a cable across a long valley here in the Eastern Cape snapped. And so it just took Eskom. I think we were off without power for about 4 days. And then on top of that,
Wow.
The guys with solar had no sun, of course, because it was raining so much. So literally there was no one online. So it was quite difficult to work. And
That's crazy. At least you had water though, right?
Yeah, we had water, but I think a lot of people didn't, especially the guys who are reliant on tanks. So you need a pump to pump the water out of the tanks. And if you have no electricity, you've got no water. So,
gosh.
Yeah. But, and then as soon as the electricity did come back on, we had a huge surge that caused our inverter to blow up in flames, which was very scary.
Oh, that's right. Yes, you almost set fire to your house, didn't you?
It was crazy. Yeah. So that was quite a lesson learned. So actually I had, the inverters have surge protectors because that's what they deal with all the time. So yeah, I'm not sure. Something overheated. Maybe it was because it was off for so long. But that was quite an interesting, at least, turn the inverter off as well and unplug it when the main's off.
For any South Africans listening to this, turn your inverter off before the power comes back on.
Yeah, and make sure it's not below curtains or a place, where something could easily catch alight. Yeah, so I woke up with the start at 11 o'clock at night because the power had just returned and I see a fire underneath the dressing table.
Gosh, terrifying.
It was.
Absolutely terrifying.
Yeah. But anyway.
Well, I'm glad you're okay.
Everyone's okay, yeah.
All's well that ends well. And you're back to talk about Forex trading.
Yes. Yeah, very exciting.
Good. Yeah, so today we're talking about trading with limit orders, which is, I think, something that a lot of traders use quite frequently. But I think a lot of beginners come in, they only see market orders and maybe not have a full understanding of how to use a limit order. So we're going to go through it today. We know that with Forex trading, there's, you have to trade with leverage. And leverage allows you to make large profits, but also it's a double-edged sword. So you can also make really large losses. And for this reason, you need to employ a really effective trading strategy and part of this trading strategy is learning how to use stop orders and limit orders to manage your position.
Yeah, exactly. So, if we just go into the basics of what a limit order is and how it works, it's in order to buy or sell an asset with a restriction on the maximum price to be paid. So that's with a buy limit, or the minimum price to be received if you're using a sell limit order. And if the order is filled, then it'll only be filled at that price that you set or better. The only problem with it is that there's no assurance of the execution because, of course, the price may never actually reach the price that you set. And a limit order is generally appropriate when you think you can buy at a price lower than the current price or sell at a price higher than the current quote price. So basically, It gives you an opportunity to get a better price than you're seeing, better than the current market price.
Yeah, no, to use an example, if you have the Euro USD trading at 1.1000 and you want to open a long position or place a buy order, you would set a buy limit at a lower price than the 1.1000. So you'd say at 10950. This would mean that only if the Euro USD fell to that level or lower, would then your limit order be triggered. And if the price doesn't fall to 10950, then no execution would occur.
Yeah. And, similarly, if you wanted to sell the currency pair when it reached 1.1050, you would place a limit order at that price. And if the price rose to that level or higher, then it would be triggered and your order would be executed. Again, if it doesn't hit that price, no execution occurs. So the order is often cancelled depending on your settings.
Yeah, exactly. And this is in contrast to a market order, which is when you want to open order as quickly as possible at the current price. And, it's providing that the market's open, the order's placed, and barring any unusual market conditions like high volatility or very low liquidity, that's how you would go about doing it usually.
Yeah, exactly. And I mean, I often sort of, I find quite a good analogy is like buying a car at a dealership. So you can buy the car at the price you see and get it immediately, or you can negotiate with the dealer to get it at a better price. But if you're stubborn, you may have to wait for the deal to go through. And of course, you could never see the deal go through if you're not willing to pay that current price, or of course, if somebody gets in ahead of you. So it's quite a nice way to think of what a limit order is.
Yeah. It's also important to note that even if that pair reaches the specified price in your limit order, your order still might not be filled. That's because there might be orders ahead of yours, and limit orders are generally executed on a first-come, first-served basis. That said, it's also possible your order could be filled at a better price than you specified. So if a buy order could execute below your limit price and a sell order could execute for more than your limit price. And this is to do with gapping or slippage. So you may get a better price than you would originally expect. So yeah, we're going to take a quick break now, but when we come back, we're going to talk about how long limit orders last for, and we'll also give you some tips on how to use them.
Hey guys, I hope you're enjoying the episode. So if you're looking for more trading education, please visit our website or FX Scout's YouTube channel. We have plenty of resources available. Our videos tackle educational topics like indicators, trading strategies, fundamental analysis, and basic Forex terms. We also provide in-depth broker reviews and platform tutorials. Again, thanks for listening. Cool, and we're back. So how long does a limit order last? Well, it depends very much on your specification and your broker's policy. So many brokers default limit orders to day-only trades, which means that any orders unfulfilled at the end of that day are cancelled without execution. So that's what we were talking about earlier, is that you might not see your order executed, especially if the broker has a policy that it will not continue with the limit order beyond a certain period, in this case, a day. Mm-hmm. And other brokers may offer a specific number of days, which often you'll see intervals like 30, 60, or 90 days. And then some brokers also offer limit orders that are considered good until filled, which means that limit order will continue to remain open until it absolutely is filled, no matter how long it takes. And that also it will remain valid if, as I said, until it's filled or if it's cancelled by the trader. So you get those three types of limit orders: the end of the day, certain periods, and then ones that are only closed once they've been filled or cancelled by the trader.
Yeah. So, and here's some key points you need to think about when you're setting up a limit order. So you want to choose the right price. Obviously, this is really important. When setting a limit order, it's essential to choose this, to get this right. This means you need to have a good analysis of the market, and you've got to determine the price at what you believe the asset is likely to move to. So you're going to be looking at fundamental factors that are affecting whatever Forex pair you're trading. It says, inflation data, interest rate decisions, stuff like this. And this will give you an idea about whether the asset is poised to move up or down and by how much. So you can use this quite a lot, limit orders around when you've got news events, when you've got upcoming news events. I think it's quite a popular strategy.
Yeah, and it's kind of how, you kind of wait for the price to reach its fair value, is often how traders put it. And next you will set the expiration date. So this is the date on which the order will expire if it's not been executed. And And it's important to choose an appropriate expiration date because obviously the longer the order is open, the greater the risk of market changes that could affect your trade. So it's sometimes not wise to keep a limit order open for too long. You could just very easily see it hit your stop loss quite quickly after that.
And finally, you need to be aware of any fees that may be associated with orders. Some brokers may charge a fee for a limit order, so make sure you're aware of that before you start working with these. And if there are fees, make sure you factor that into your trading strategy and into your costings.
Yeah, exactly. Kind of like looking at the spread. You'd only open a trade and once you understand how much it's going to cost you. Then if you want, so if we look at tips for maximizing limit order success, one useful tool for managing risk when using a limit order is the stop loss. And it's an order that'll automatically sell an asset if it falls to a certain price. So using a stop loss with a limit order, you can better manage your risk and protect your trades. So if you place a buy limit order on a Forex pair and it starts to drop in price, then your stop loss will be triggered to sell the Forex pair, and it'll obviously limit your losses. So it's quite a good idea when you place your limit orders to place a stop loss, a provisional stop loss in place as well.
Exactly. I mean, and this just goes back to what we say quite often, which is always use a stop loss, no matter what you're doing. It's good discipline. Second thing for maximizing your limit order success is you have to be patient. So when it comes to using limit orders, this is really important. They obviously take long to execute the market orders. So you need to be willing to wait for the right price. This requires discipline, requires, just keeping your emotions out of the trade. Don't cancel it too early. And because patience will pay off in the long run. As long as your analysis is correct, then your patience is going to work out for you and you'll be able to get a better price on your asset, whatever it is you're trading.
Yeah, and then of course technical analysis. It's a very powerful tool when it comes to executing your trades, and you can also use it very effectively to set your limit orders. So once you've analyzed your charts and you use technical indicators, then you can get a better understanding of the price movements of that asset, and it'll allow you to make informed decisions about when to place the limit orders and at what level you want to place the limit orders.
Yeah, and finally, it's important to consider the spread. So the spread is the difference between the bid and the ask price of an asset, and it will really impact the execution of your limit order. If your spread is too wide on whatever asset you're trading, it's going to be difficult to get your order filled at the price that you want. So in these cases, you may need to adjust your limit price or consider using a different order type. So always be aware of the spread on whatever asset it is that you're trading before you set your limit order.
Cool. Well, I think that about covers it, Chris. I don't know if there's anything else you want to add in your experience.
No, I think that covers it. They're they're useful tools. They do, as I said, require patience, and they require a good analysis of the market, a good understanding of the fundamentals and the technicals before you use them. But once you do, and you have that patience, I think you can. They're really useful, and you manage to increase your profits by quite a fair margin if you use them correctly.
They're also very useful for traders who can't sit at the charts all day. Sometimes it's quite difficult to wait for a price to hit a certain level. So, I find them very useful from that perspective. I can just, know that once a price hits that and I've done my analysis well enough, that, I'll likely be successful with those trades.
Yep. That's a very good point. Yeah. But I think that sums it up. Super. Well, I look forward to speaking to you again next week, Alison.
Yeah, me too. Thanks, Chris.
Cheers then.
Bye.